if either Japan or China decided to sell off a large chunk quickly. Their actions directly hit Treasury yields. And those yields, they're kind of the baseline for interest rates everywhere. So if they sell, pushing yields up, that can flow through to, mortgage rates here, the cost for businesses to borrow money, even what the US government itself pays on its debt. It's all connected.
You ever find yourself just thinking about, well, the stability of things, like your investments or maybe the bigger economic picture? And the US Treasury market often comes up. It feels, I don't know, fundamental, but maybe a bit abstract sometimes.
It definitely can. It's the bedrock, but yeah, distant for many people.
Well, you, our listener, actually sent in some really interesting material financial analyses focusing right on US Treasury bonds back in March and April of 2025 and what experts were projecting then.
Ah, yes. Remember looking through those. Some fascinating perspectives.
So this deep dive is specifically for you. We're going to unpack those analyses today.
Absolutely. And these weren't just quick takes, were they? The sources really dug into potential pressure points for treasuries around that specific time frame. We're talking forecasts, scenario planning.
Stuff with real potential implications. Okay, so our mission here is basically to pull out the critical insights from these expert views on the Treasury market in March, April 2025, and, what they saw coming down the pike, without getting totally lost in the weeds.
It sounds like a plan. Where should we start?
Let's kick off with something that seemed pretty prominent in the analyses, the big international players, specifically Japan and China.
Right. You really can't talk about the Treasury market without talking about them. They're huge holders.
How huge are we talking?
Well, Japan, for instance, as of late 2024, the analysis mentioned holdings around, what was it, $1.1 to $1.2 trillion.
Wow. Okay.
Yeah. So, even relatively small decisions on their part can send ripples, big ripples, through the market.
And the document suggested reasons why Japan might have been thinking about selling some treasuries back then.
A couple of things. One was, simply better opportunities potentially opening up back home in Japan. If their domestic economy improved, maybe investments there looked more attractive.
Makes sense. Keep the capital closer to home if the returns are good.
Exactly. And then there's the whole history with the Bank of Japan's policies, like yield curve control.
Right.
That likely played into their strategy for managing foreign debt, too. It's complex.
And then there's China.
Right. Their holdings were estimated a bit lower, maybe $800 to $900 billion before late 2024. But what stood out in the material you sent was the link analysts were drawing between potential political shifts.
Okay.
And specifically those tariff announcements around April 2nd, 2025. The idea explored was whether China might strategically sell off some treasuries as a kind of response.
So less about pure economics and maybe more about geopolitical leverage or signaling, using their treasury holdings as a tool in response to those tariffs.
That's certainly the connection the analysis explored. And it was pretty clear if either Japan or China decided to sell off a large chunk quickly.
Volatility.
Nighttime volatility, we're talking trillions globally.
Yeah.
A significant shift in supply really moves the needle on prices and yields.
Okay, so step back for the listener. Why should someone managing their own portfolio or just interested in the economy care so much about what Japan and China do with U.S. bonds?
Well, because their actions directly hit Treasury yields. And those yields, they're kind of the baseline for interest rates everywhere. So if they sell, pushing yields up, that can flow through to, mortgage rates here, the cost for businesses to borrow money, even what the U.S. government itself pays on its debt. It's all connected.
Gotcha. Okay, that connects the dots. Now, another thing these analyses explored was a specific what-if scenario, interest rate risk.
Always a major concern in the bond market.
Specifically, they looked at the 10-year Treasury yield. It was around 4.21% in March 2025, according to the documents. What if it jumped by a full percent, up to about 5.21%? What were the potential knock-on effects?
Yeah, that's a significant jump. And the first, most direct impact is on the bonds themselves. Basic bond math. Yields go up, prices go down.
The inverse relationship.
Exactly. So a 1% yield increase on that 10-year note could mean its market value drops potentially quite a bit. The analysis suggested maybe 7% to 9%.
That's a hefty haircut for anyone holding those bonds.
It is, especially for large institutions. But the ripples, like you said, spread out.
Where else would we feel it?
Think housing. Mortgage rates often follow Treasury yields pretty closely. So higher Treasury yields likely mean higher mortgage rates.
Making houses less affordable, potentially slowing down that market.
Right. And businesses, too. If they
Yeah.
want to borrow money for, say, a new factory or equipment, their borrowing costs go up. That might make them pause those investments.
And Uncle Sam, the government's borrowing costs.
They feel it, too. Higher yields mean the government pays more interest on its massive debt pile and on any new debt it issues. That strains the federal budget.
The analyses also mentioned a psychological element, didn't they, if yield shot up quickly?
Yeah, that's crucial. A rapid rise could spark fears that inflation isn't going away, that it's getting sticky, or even worse, fears of stagflation, that nasty mix of slow growth and high inflation. And fear itself can drive market behavior, potentially leading to more selling of bonds as people get nervous.
A negative feedback loop.
Potentially, yes.
Now, intertwined with interest rates are, of course, fiscal risks and policy uncertainty. The documents highlighted this for Q2 2025.
They did. One point was an expected shift in focus. Q1 2025 seemed dominated by tariff talk.
Right.
And the analysis suggested Q2 might pivot more towards tax policy discussions and uncertainty around future tax rules. That can make investors hesitant, including about buying government bonds.
Because they don't know the future landscape they're investing in.
Precisely. And add to that the existing budget deficits. If borrowing costs are rising, like in that 1% yield increase scenario,
It makes the deficit problem worse.
exactly, you have to borrow more just to pay the higher interest on the debt you already have. It can become, as you said, a bit of a vicious cycle that markets watch very carefully.
And the tariff situation, even if the focus shifted, was still an issue through April.
According to the analysis, yes. That uncertainty could act as a drag on economic growth, while also potentially pushing up inflation via import costs. That's a really tricky backdrop for the bond market.
Okay, let's put some concrete numbers on the table. According to these sources, what did the yield curve actually look like around March 31st, 2025?
All right, let's see. The figures cited were 3-month Treasury yield at about 4.29%,
Oh,
6-month at 4.22%.
lower. Interesting.
Then the 2-year Treasury was down at 3.89%.
Whoa. Okay, so the very short end is higher than the 2-year. That's an inversion, right?
That's right, the 3-month yield being higher than the 2-year. And historically, that kind of inversion is often seen as a potential warning sign.
For recession.
Often interpreted that way, yes. Or at least indicating market expectation of weaker growth and lower rates ahead.
But what about further out, the 10-year and 30-year?
So the 10-year yield was 4.21%.
Okay, higher than the 2-year.
Correct. And the 30-year was higher still at 4.58%.
So the curve was inverted at the short end, but upward sloping at the long end.
Exactly. And the analysis projected that the long end might actually get even steeper the gap between the 10-year and 30-year widening.
What does that steepening suggest?
Usually, that points towards concerns about longer-term inflation. Investors demand a higher return, a higher yield, to lock up their money for 30 years if they think inflation might erode its value more significantly over that time.
So putting it all together, that yield curve shape back then was pretty unusual, wasn't it? Inverted, short, steepening long.
It really painted a picture of significant uncertainty. You had signals potentially pointing to near-term economic weakness and concerns about long-term inflation all mixed together. Not a clear, straightforward outlook.
Yeah, reflects a market kind of hedging its bets, unsure which way things will break.
Definitely reflected a lot of questions about the economy and policy direction.
Okay, beyond those big macro factors, rates, policy, foreign holders, the analyses you sent also flagged some, let's say, structural or market-specific risks, things inherent to how the Treasury market itself works?
Yes, and these are important because they can act like amplifiers during stressful periods.
That-
Well, one point was about market making. Regulations brought in after the 2008 crisis, while well-intentioned, might have reduced the ability or willingness of big banks, the dealers, to absorb huge sell orders in treasuries during a panic.
So less shock absorption capacity.
Potentially, yes.
Yeah.
Which means price swings could be more violent if there's a sudden rush for the exits.
And technology probably plays a role here too, algo trading.
Absolutely. High-frequency trading, algorithmic strategies, they add liquidity in normal times, sure. But in volatile moments, their speed can actually accelerate a sell-off as they all react almost instantaneously to the same signals, pouring fuel on the fire, as they say.
Right. The analyses also seemed wary about the Federal Reserve's role, didn't they? Communication, missteps.
Always a risk. Central banking is a delicate balancing act. If the market gets ahead of itself expecting, say, big rate cuts, and then the Fed doesn't deliver because inflation proves stubborn.
You get a sharp repricing.
Exactly. A potentially disruptive adjustment across markets, definitely including treasuries. Clarity and careful management of expectations are key.
Let's loop back quickly to those big foreign holders like Japan and China. If yields did spike significantly, what happens on their end?
Well, remember those huge holdings. A spike in yields means the market value of those bonds drops significantly. That hits their balance sheets.
Right.
That could create pressure internally, maybe pressure to intervene in currency markets to prop up their own currency, which might mean selling dollars and thus selling treasuries.
Or even just political pressure at home saying, hey, maybe we shouldn't hold so much U.S. debt.
That too. It could accelerate diversification efforts, pushing them to look at other assets, other countries' debt, maybe even gold.
And if multiple central banks start diversifying away from treasuries,
That becomes a bigger issue for global stability. A major shift away from the world's primary reserve asset could destabilize rates globally. It's a significant tail risk.
okay, let's quantify the budget impact again.
Right.
That 1% yield increase scenario, the analyses put a dollar figure on that.
Yeah, the estimate mentioned was around $200 billion per year in additional interest expense for the U.S. government for every 1 percentage point increase in rates.
That's a lot.
It adds up fast, especially with the existing debt levels. And it's not just the federal government. Higher treasury rates tend to crowd out other borrowings, making it more expensive for states, cities, and corporations to borrow and invest too.
And within the plumbing of the financial system itself, what were the stress points mentioned?
A few things. Money market funds, which hold tons of short-term treasuries, a yield spike could cause net asset value issues, potentially leading to outflows.
Like we saw glimpses of in past crises.
Exactly.
Yeah.
Also, think about margin calls. In derivatives markets, in the repo market where treasuries are used as collateral, rising rates and falling bond prices can trigger margin calls, forcing institutions to sell assets, potentially including treasuries, into an already falling market. Fire sales.
Not good. What about banks? That steepening long end of the curve we talked about.
Yeah, that can be tricky for banks too. If long-term rates rise much faster than the short-term rates they pay on deposits, it can actually squeeze their net interest margins, the difference between what they earn on loans and pay on deposits.
So lots of interconnected risks there. Policy uncertainty too, right? Like if the Fed thought it could cut rates, but then inflation stuck around.
Right, that policy pivot uncertainty.
Right.
If the market prices in cuts and then the data forces the Fed to backtrack or hold off, that causes volatility.
And it all seems to feed back into that fiscal sustainability concern.
It really does. Rising interest costs widen the deficit, which requires more borrowing, which can put more upward pressure on yields, especially if buyers get nervous about the long-term debt trajectory. That negative feedback loop again.
Especially when debt to GDP is already high, making the whole situation more sensitive to shocks.
Precisely. Higher debt levels reduce your fiscal space, your ability to respond to the next crisis, whatever it might be.
And those shocks could be anything: geopolitical events, sudden policy changes like tariffs. Exactly. Events like new tariffs or unexpected political shifts can inject immediate volatility into treasury markets, as we discussed with China. One last area mentioned was liquidity and technical strains, things like the Treasury General Account.
Yeah, more plumbing issues. Fluctuations in the government's cash balance at the Fed, the TGA, can impact liquidity in short-term funding markets. And constraints on dealer balance sheets, which we touched on earlier, can also affect how smoothly these crucial short-term markets operate, especially during stress.
Okay, wow. So pulling all this together from the analyses focused on March and April 2025, it really sounds like the U.S. Treasury market was seen as navigating a pretty complex and potentially risky period.
That's definitely the picture painted by these sources, yeah. You had this confluence of factors, the influence of huge foreign buyers, potentially shifting strategy, the direct and indirect impacts of potentially higher interest rates, significant fiscal and policy question marks, and these underlying market structure issues that could amplify problems.
A challenging mix.
The takeaway from these documents was clearly that this period warranted close watching and held notable risks for Treasury bonds and, by extension, the broader financial system.
And for you, the listener, understanding these forces isn't just theoretical. I mean, these are the currents that can shift the ground under your investments, influence the cost of borrowing, and shape the overall economic climate.
Absolutely. These dynamics matter, whether you're an institutional investor or just planning for your own financial future.
So maybe here's a final thought to leave you with based on this deep dive into those 2025 analyses. Given all those potential headwinds and uncertainties that experts saw facing the Treasury market back then, What might have been some alternative approaches or maybe just key considerations for long-term financial planning? And zooming out, how might those factors discussed have ultimately influenced global economic stability in the years that followed?
Good questions. Definitely food for thought.